Welcome to the Property Buyer podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Well, welcome to another edition of the Property Buyer podcast. In this episode, we'll be looking at the current economic climate and the impact of 13 interest rate rises on the property market. Now, some pessimists are saying we're heading for a recession and that the cost of living will devastate many households and businesses, while other economists are suggesting the property market will be quite resilient and continue to rise in 2024. To help make sense of just how robust households will be in the face of hurtful inflation and to see if our economy will be able to cope, we have well-known expert Shane Oliver, Chief Economist at AMP, to share his perspectives. Welcome, Shane. It's great to have you on the podcast today.
Thank you, Rich, and thanks for having me. It's great to be here.
So, Shane, we have a tradition on our Property Buyer podcast where we start with a thought of the week. And this week it's by Theodore Roosevelt. And he says, "Believe you can, and you're halfway there." What do you take from that?
I think it really just highlights the importance of belief and mindset. If you start with a negative attitude and think that it's too hard, then you've probably got a lot further to go. Whereas if you have a positive mindset, then that will do a lot of the work. Take it to the extreme. Sitting behind me on the bookshelf is a book called The Secret, which
Yes,
I think was sent up. The Chaser on the ABC, something I think it was called The Chaser.
Yes.
I forget their names, but anyway, they set it up. All you've got to do is close your eyes when you're going into a car park, and a car park will materialise for you. And of course, the car crashes into a parked car. But the concept behind The Secret is that if you envisage something and get your mind, then the universe will move in ways that will make it work out for you.
It's great.
That's probably a little bit too extreme, and lots of people would argue with that, but there is some truth to that, and I think Theodore Roosevelt is tapping into that effectively.
Yeah, exactly. I think there is something to be said for visualization, but certainly not at the cost of stupidity. So, great quote. But I definitely think you've now hit the nail on the head. Mindset is very much what he's about, and if you don't have self-belief and some sense of confidence, then it's going to be pretty hard for you to achieve your goals. So, Shane, I'd like to just kick off with a couple of questions. Tell me a little bit about your role at AMP as Chief Economist, and also just your work there. How does your assessment of the economy actually impact on what happens within AMP?
Yeah, sure. Look, I'm one of those few people who've been at one company for a long time. I joined AMP back in the 1980s. I became chief. That was sort of like a lowly research role. I became chief economist in 1994 and then head of investment strategy in the early 2000s. It's a company that I've been proud to work for. I must say there's been some horrible patches where that pride was diminished through the Royal Commission and the events of 2020. But it for purpose, which was to be a sure friend in uncertain times. It hasn't always lived up to that purpose. But I think many people at AMP have wanted to, and unfortunately a few people over the years have not. But it seems to be getting back on track. So I'm once again proud to work at AMP. But my role, most of my life at AMP has been in the investment team, focused around, I guess, investment strategies. So we formulate views or macro views on the outlook for the economy, on interest rates, on share markets, on property markets, all sorts of other asset classes, and what that might mean for investors in particular. That then impacts across the major asset classes. But it's also fed through to, I guess, the financial advisor network that is connected to AMP and is used for their clients, and I guess also helps to some degree in the business strategy at AMP, although sometimes not always. But that's basically the role. It's something that I love. Economics was my first love, and then combining that in a practical way with investment decisions seemed to me the ideal world in terms of a career.
What do you love about economics? I mean, I studied economics at university myself and did a double degree and a master's at Macquarie Uni, and I actually became an environmental economist for about 10 years in government before I started my property business. And I liked it because I just interested in how the world works, and not just the money side of it, but just how the economy works, how the macro and the micro side of things. But yourself, what do you love about economics yourself?
Look, it's a combination of things. It sounds like we've got quite a bit in common, living on the northern beaches and going to Macquarie University. I fell in love with economics at high school, a school called Barrenjoey High School. People would associate Barrenjoey, if they know it, with the beach because it's built in sand dunes. The economics teachers there, a guy called Mick O'Rourke, and then Mr. Tracy, I can't remember his first name, they got me really enthused about economics. This was the time when there was a bit of malaise going on. We had very high inflation and high unemployment, or stagflation, and I loved the insights that economics could provide in relation to all of that, but also what it means at a very individual level. It made me aware that a lot of our day-to-day existence involves economic decisions. You could argue they're micro decisions, but they also impact the broader economy. And so I fell in love with economics when I was in my teens, and then studied it at university and kept going, and ultimately got a PhD in economics. I initially didn't like financial economics. I thought I was more of a lefty hippie type, and wanted to wear a brown suit rather than a dark blue suit. But ultimately, I realised that there's a lot of interest in financial economics and fascinating stuff. So the topic of my thesis was theories of speculation in asset markets, which a couple of years later might have been called speculative bubbles. And interestingly, that sort of led me to the property market to some degree, because there's a chapter in there on booms and busts in the Australian property market. Of course, this was a long, long time ago, and the data back then on Australian property was nowhere near as robust or as thorough as it is today. But anyway, I concluded that I wanted to be an economist. I think when you're in high school, you don't have any conception as to what a person who studies economics does, apart from being a school teacher, perhaps. And I then concluded, once at university, I worked out there's lots of other things economists do, and then decided I should be an economist. And then I guess that's how I got into it.
Fantastic. So thinking about all those that great training you have, I'd like to ask you some questions just around where we're at right now in the Australian economy. If you had to sort of summarise in just a couple of words the Australian economy right now we're December 2023, how would you describe our current situation?
Look, I'd say we're doing that far better than expected, but there's still a few risks on the horizon, and you'd have to say that some are doing well and others aren't. So it sort of makes it a little bit patchy and messy, but it's nowhere near the calamity that I think many have tried to portray. I don't see it as a disaster or a disaster waiting to happen. I think the big surprise has been how resilient the economy has been. And when I look at other countries around the world, I know a lot of people say, well, we're failing and we've got inflation at just over 5 or around 5%. Other countries, they've got it down to 3%. Europeans got 2.5% or 2.4%. when it came out for November. So why are we so bad? I don't think that it's that bad, actually. I think the reality is that we lagged the rest of the world on the inflation front. They took off before us. They got a lot higher than we ever did. Europe got to about 11%, 10, 11%. The US got to 9%. Peak in the US was in middle of 2022. We didn't reach our peak of around 8% until the end of 2022, so about 6 months behind, and we're now coming down. And we do have some very high numbers to drop out, which from late last year. You may recall, if people follow these things very closely, that we had a big surge in travel-related expenses or prices at the end of 2022. The revenge surge travel will drop out. The travel boom, or it's partly a reopening boom. But the problem is we reopened after other countries. We reopened through 2022. Many other countries reopening through 2021, and that meant that the inflationary boom surge hit in those countries earlier than it did in Australia, and therefore we're lagging a little bit, and the downswing is lagging a little bit as well. But we are coming down just as those other countries have. So that's the good news. Of course, the bad news is that there is that risk of recession, but I'm hopeful we'll be able to avoid that. It's not my base case.
What risk of recession do you put us at? Like a 20%, 40%, 50%? What do you have if you're a market trader?
Earlier this year, I was starting to think maybe it's close to 50%. The Reserve Bank's going totally crazy, but I probably wound that back a little bit now. It's high, but I'd say it's 40, 45 maybe percent. So it's a significant risk.
Yeah.
But there's a couple of qualifications around that. Base case is I think we will avoid it because inflation is coming down. I mean, some people say we've got to push the economy into recession to get inflation down. Well, inflation's coming down all around the world anyway.
Yeah.
And so it looks like we don't have to push economies into recession to get inflation down. Secondly, apart from the surge in inflation, we don't have a lot of excesses built up in the economy. Obviously, there's a lot of household debt for the 30% of households that have a mortgage in terms of, but we haven't had a consumer spending boom. We haven't had a business investment boom. The last mining investment boom was a decade ago, so all the sort of the boomy things that often give you severe busts just aren't present. And the combination of those two things suggests we should be able to get through this without having a recession, albeit we will see do have a recession, it will be a relatively mild one.
So, Shane, we've had 13 interest rate rises since May last year. It's been one of the most rapid increases we've seen in decades. You mentioned sort of households seem to be resilient, but how do you think that's actually playing out for the average consumer? Do you think they're going to get through? We've been hearing about this fiscal cliff as well. Do you think that's a myth or reality?
Well, it depends. If you look at the average consumer, I think the average consumer will get through because the average consumer reflects a whole range of different circumstances. Roughly in terms of home ownership, ignoring renters, there's about a third of people a third of households own their own house outright, about 1/3 own it but with a mortgage, and about 1/3 are renters. The third who own outright are in reasonably good shape. That they got a benefit through the pandemic, weren't able to spend. Some got government top-ups and were able to pay their mortgage off, and they're generally sitting pretty. Often these are baby boomers, but not necessarily. I don't want to hammer the baby boomers too much because I'm a baby boomer. But that group's in reasonably good shape. Then you've got the renters. Yes, there's been increases in rents, and that's causing pain there and constraints on their spending ability. But the pressure there is probably not as great as it is for some homeowners with a mortgage. And even there's groups. For example, the RBA has done an analysis, which if you look at the situation for those combine the situation with fixed rate and variable rates, they worked out, and if you put that two groups together, that 1 in 7 were cash flow negative as of July. In other words, their income levels were less than their essential expenses and their mortgage payments. So that group are clearly at very high risk. And it's probably even a higher share now because we've had another interest rate hike since July, and more people on fixed rates have been pushed through to variable rates. So that group is probably somewhat bigger now. It might be 2 in 7. But then you've still got a big chunk of people with a mortgage who are struggling, but they're still in sort of okay shape. And consequently, when you look at the consumer as a whole, I think on average consumer spending will slow down, and it's probably already doing that. If you look at retail sales are actually going backwards on a per capita basis in real terms, or a per person basis in real terms. But overall consumer spending seems to be just remaining in positive territory, and I suspect that continues into next year. It might dip into slightly negative territory, but I think there's enough groups within the household sector as a whole to sort of keep things going, or if there is a bit of a dip into negative territory, not enough to cause a collapse. And I guess the other aspect is that there's other parts of the economy. Housing investment or housing construction seems to be ticking over. It's been big approvals. But there's a huge pipeline of work yet to be done. So when you get that lower level of approvals, there's still a lot of construction yet to occur because of the big pipeline of approvals yet to be completed. And business investment is referring to a slowdown, but not a collapse.
Yes. Yeah.
So when you add up all those pieces, you get sort of positive growth, but albeit much slower than we've become used to. But it is the consumer that's the one to watch this time around. If there's going to be a severe recession, that's where the risk is. And that's why I think the Reserve Bank does have to tread carefully from here. I know the recent comments by Governor Bullock have indicated ongoing concerns about inflation. But she's also said it's at time for the RBA to be careful, given that they've already raised rates a lot. So
it's interesting language that she's put out lately, isn't there? She's put a bit more caution around how hard they're going to pull the trigger, and I've sort of found that interesting. So she's very cognizant of that sort of 1 in 7 or 2 in 7 people that you're talking about that are more in negative cash flow.
She is. I think she is, and I know a lot of the media has sort of jumped on the bandwagon. Oh, well, maybe she's going to raise interest rates again, and that's possible. That's where the risk is. But she's also indicated caution around that, as you point out. Which I think is quite healthy. You can get both sides of the story from the RBA. The RBA, I think, is between a rock and a hard place. On the one hand, they're charged with getting inflation down. If they don't, then they lose credibility.
Exactly.
On the other hand, they don't want to cause a recession.
So one thing that I've found interesting, Shane, is we had so much injection into the economy during the COVID years, where it's just, I can't remember the actual figure, you'd know it better than I do, but it seems like the usual length of transmission for interest rate rises, have taken a lot longer because so many people have been on fixed rates. So I think, my understanding is the usual transmission time for a one interest rate rise to filter through the economy is, 3 to 6 months, but it seems like it's a lot longer time period. What do you estimate the time period has been because so many people have been on fixed rates to actually hit the hip pocket nerve of the consumer now?
Yeah, there's an old saying from the well-known economist Milton Friedman that the impact of monetary policy on the economy is associated with long and variable lags. Sometimes you hear talk of 12 to 18 months. At this time around, it looks like it's pushing towards the longer end of that. Maybe 18 months, could be up to 2 years. There's several reasons for the longer lags. You mentioned one in there, which has been a big one, that coming into this interest rate tightening cycle, we had 40% of homeowners or people with a mortgage with fixed rates. The norm is about 15%. And going into the 1990s recession, we didn't even have fixed rates back then. So that means there's a greater proportion of people who saw a delayed impact of the higher interest rates. Of course, that's now starting to unwind. We also had the distortions caused by the pandemic. Coming out of the pandemic, the household sector, on average, was in better shape financially than it was going into it because of people couldn't spend, they had to stay at home, lockdowns. So people had an income boost, particularly where JobKeeper was paid and other government benefits were paid, but they couldn't spend. So they built up what you call excess savings, which some estimates put at 20% of household income in excess savings. So this is a level of stock of saving above what otherwise would have been the case were it not for the pandemic. And so that's provided buffers that the Reserve Bank often refers to. Then there's the reopening boost that people were locked up in the pandemic. They were just happy to get out there and spend, regardless of the bad news of cost of living pressures and high interest rates. I know some individuals might debate this, but that's what the numbers show, that people were actually quite happy to get out there and spend, and that explained why restaurants were full and cafes were full and couldn't get enough workers. And then you've had unusual strength in the labour market, which has also provided a bit of an offset. So all of those buffers have helped lengthen the lag from high interest rates to the impact on the economy. And it's the impact has been thought a year ago. I thought we were at the peak on interest rates a year ago when we'd reached around 3%. But we've gone a lot higher than that, and those sorts of things partly explain it. I guess you've got to be a little bit careful though. I started my career in the 1980s, was around when interest rates were raised from around 10.5% to 18%. That's the cash rate. In 1988-89, rates went up continuously. Ultimately, it resulted in a 17% mortgage rate. The economy seemed very resilient. Paul Keating at one point, the then Treasurer, said something to the effect that it's like effervescent champagne in a champagne glass that is so bubbly that it's overflowing the sides. Then, of course, and right through that period, unemployment kept falling. And then suddenly in 1990, we had the recession that Paul Keating then said we had to have. So, things could change quite quickly, and suddenly that lag caught up. So that is the risk here, and that is something the Reserve Bank does need to be really careful of.
Yeah, that's right.
Of.
Exactly. Yeah. So let's turn our attention to the property market now, if we can. I'm curious to hear what your forecast and outlook is for the property market in each of the capital cities over the next, say, 1 to 2 years, for years 2024 and 25. What do you think is going to be the impact of, where we're at with the economy and inflation and interest rates on the market?
Well, the property market's been amazingly resilient, and partly reflecting the strength in the economy. Immigration's been a part of that, or a big part of it. But anyone listening to this would probably recall we had a year ago, we were in a slump in property prices. They came down almost from the day the RBA started to raise interest rates, and then depending on where you were, Sydney I think came down about 11 or 12%. To its low point in January of 2023, and then other cities came down by much less. Typically, on average, I think the fall on the core logic data was about 8%. If you look at some of the other data providers, PropTrack, for example, the fall was a bit less. Then prices started to rebound, and it seemed as if the interest rate effect was wearing off, even though interest rates kept rising. But I think that the big drivers of the rebound in 2023 were the perceived shortage of property in the face of the immigration rebound, so that was a big factor. We also saw the rise in rents, so people who were sitting on the sidelines thinking they wanted to get into property, if they might have been renting, thinking, well, I don't want to pay 20% more rent, I might as well buy. There was an element of FOMO there. Again, people who were waiting to buy into the market, thinking they'll get lower prices on the back of higher interest rates. There's typically people who were cashed up or had access to the bank of mum and dad, weren't so interest rate sensitive. They then came in thinking, well, markets probably bottomed. We saw the return of foreign buyers, although I think the impact of that is often exaggerated. And then property market rebounded nationally. We've hit record highs. Obviously, Perth, Adelaide and Brisbane have been the drivers of that. Sydney's and Melbourne are lagging a bit. So 2023 is probably going to see a national gain of about 8%, possibly 9%. 2024, I think, is going to be slower and tougher because the interest rate drag is still there, and the lagged impact of the higher rates will start to impact as well. Like a rough calculation on our estimates is that someone with a 20% deposit on full-time earnings, their capacity to pay, reflecting the lower amount that they can borrow when they go to the bank, is now down about 30% from where it was prior to the start of rate hikes in May 2022. And so that obviously affects buyer potential in terms of how much people can pay. And I suspect that could result in a bit of a drag in prices in Sydney and Melbourne, maybe Hobart and Canberra. So those cities might see slight dips in prices. Adelaide, Perth and Brisbane, I think, probably remain in positive territory. But the upshot of all of that is we're going to see a somewhat slower year. And just as 2022 surprised on the downside, 2023 surprised on the upside, 2024 might surprise on the downside. That said, I don't want to get too bearish here because property market is often surprised in terms of its resilience. Providing we avoid a recession, or if we just have a mild recession, our base case is that we will avoid a recession, but if we do have one, it'll be a mild one. If that turns out to be the case, then I think you're not going to see a massive rise in unemployment causing huge problems for the property market. There might be some problems there, but not enough to cause a collapse. And the other thing is that the property shortfall, the underlying shortfall of Australian property relative to underlying demographic demand will remain in place. We estimate that we're already at a shortfall of about 120,000, and this will grow further into next year.
It's funny you talk about
consequently, the full if we do get falls in cities, they'll be limited. And then as we go into 2025, I think the property market will start to turn up again, and we'll end up with another stronger year. Because as we go through this year, I think the Reserve Bank, or as we go through 2024, the Reserve Bank will realise it's done enough. Inflation's coming under control. We don't have to see inflation go all the way back to 3% on a headline basis to see them start cutting interest rates. All you need to see is lower rates on a quarterly basis heading in that direction. Then they'll get some scope to start cutting probably in the third quarter, into the fourth quarter, and then ultimately will then sow the seeds of a new upswing in the property market more generally.
We really appreciate you tuning in to the Property Buyer podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word of mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now let's get back to the podcast. Interesting. Yeah. Look, I totally agree with you on the supply constraint within the economy. I've been tracking the numbers for the last 25 years on supply, and I remember sort of around 2015, 2016, we had still a significant shortage, but between sort of 2015 to 2019, we had a bit of catch up. We actually sort of almost got to a period where we didn't have too much of a deficit in property under supply. But now it seems, as you say, what was your number? 100,000 dwellings, 120,000 dwellings short?
It's about 120,000. I must admit, these numbers vary. You go to the National Housing,
of course,
Supply Council, or it used to be called, that was National Housing Finance Investment Corporation or something on those lines. They've done an estimate, which I think was a bit less than that. But I did an estimate based on data going back over the last 20 years, and I get about 120 or thereabouts. It all depends on your estimates of underlying demand. That's where it gets, tricky.
But I look at the numbers, and we should be building somewhere between 160 to 180,000 dwellings a year. But if we look at the migration numbers that have just come in, we've had somewhere almost 500,000 people because of COVID catch-up. It's 500,000. The usual number of migrants are somewhere around 220 to 250,000. But it looks like, next year could be 350 to 400, and then 300 the year after. So there's, 1 to 1.1 million people within a 3-year period, which in my view is just going to create a massive structural deficit in the supply of property, which is going to, as you talk about, create that literally underpinning the property market and putting a floor. So even despite the higher rates, the fact that just basic economics says we have a major shortage of housing is unfortunately going to be tough for renters and for owner-occupiers that want to get into the market. And I think particularly the first-time buyers, they're going to be relying a lot more on the bank of mum and dad for that initial deposit to get into the market. And I think for people looking to get into the property market, they have to adjust their expectations that's going to be based around their reduced borrowing capacity. But I think to the point of, your point about being slower and tougher next year, I would agree with that we are seeing buyers being a bit more cautious. They do want to get in. And I think there's probably not as much FOMO as there was. But once we start to see talk of rate cuts, middle to late next year, it'll just, in my view, reaccelerate the interest in the property market. It's interesting how media tends to drive a lot of people's behaviour, thinking, gosh, I better get in before the next upswing. But I think the drag on people's borrowing is going to be a big one. I'm curious to know, just on that side of things, Shane, your view on the number of forced sellers out there. Do you think we're going to see a rapid rise in the number of mortgage holders that are struggling to keep up? Do you think it's going to be a major issue or a minor issue in the coming year?
I think it will be, I wouldn't say major. I don't think it's going to be enough to cause, a meltdown in the property market or huge problems for the banks, for example. But I think we will see a pickup. It's just not going to be catastrophic. The reason I think we'll see a pickup is that as we go through into next year, we'll see a slight tick up in unemployment. That in turn, I think, will lead to increased distress selling as we go through the year. that group that I referred to earlier, based on RBA analysis, 1 in 7 with negative cash flow, that's the group to watch. Obviously, it's a bigger group now, but it does suggest that there is a pool out there of people who potentially could default, or they may not necessarily default, but they may just decide, well, we'll sell up rather than default, because Australians will do anything
exactly to hang on to their house. Exactly.
Bad rap from the banks. And it is noteworthy that when you look at the listings numbers for several cities across Australia, Sydney and Melbourne in particular, they have been picking up since the middle of the year. Normally you get this pick up around the spring selling season, but this year it started a little bit earlier, which suggests there may be a little bit of forced selling in there. It's always hard to tell, but there could be an element of or just not forced selling, but distressed selling, people who are thinking, this is just too much for me, I might as well take advantage of the higher prices and get out. And potentially also some investors who are doing the sums and finding that their mortgage rate is well above their net rental yield on the property, and investors don't mind a bit of negative yields. That's the nature of negative gearing.
That's right.
The taxman might help make it up at the end of the day, but if it gets too excessive, it becomes hard to fund the property. So there could be an element of that from investors as well. But the bottom line is, I don't think it's going to be enough to give the often predicted crash in the property market. And unless you get a severe recession with much higher unemployment, then I don't think it will be of an order that causes a crash in property prices. And I should also point out that, as you mentioned, the immigration numbers there, 500,000 people. Well, in my calculation, for the last financial year, this financial year, the government was talking about a big pullback in the budget. I think 315,000 immigrants. It's hard to see it's getting that low, but it's still going to be a high number. It's quite possible that unemployment just rises because there's more people coming into the jobs market as a result of the rise in immigration, which could mean that even though unemployment goes up, it's not necessarily the case that existing Australians with a mortgage actually lose their jobs. It's just there's more entrance to the workforce. So that means the rise in unemployment that occurs may not be as bad as it has been in some previous cycles. Time will tell on that one. I guess there's always a flip side. If you do have, you get this where it gets complicated. If you go into a severe recession, worst case scenario then might be we get the severe recession. That has an impact on the property market, and you potentially get a fall. And things can be magnified because the government then might say, well, we've got to slash the immigration levels to much lower levels. And then you get a sort of a double whammy on the property market. But I think that's unlikely that we go into that sort of scenario. But the bottom line is, and I agree with your comment there, that we're looking at housing shortfall for as far as the eye can see. The government has referred to a range of commitments to boost housing supply, 1.2 million homes over 5 years, which is fantastic. It remains to be seen whether they
great to have a target, but I just think it's an unreal. It's like anything. I mean, it's a bit like our comment at the beginning. We can believe it, and we're halfway there. I think we might get halfway there. To be honest, Shane, I honestly don't think we're going to hit the target because
it's
the difficulty with councils to actually get approvals. Honestly, it is just the whole. Yes, the politicians are trying to make some moves toward improving median density. We just saw the announcement in New South Wales around duplexes and some R3 sites, but it's not enough to really boost the supply to the underlying demand. But
certainly not.
Yeah.
Just a rough calculation during that boom time period, unit building boom in the late 2010s, when there was cranes all over Sydney and elsewhere. I think we managed at 1 year to get to about 220,000 starts. So we almost at the 1.2 million over 5 years is about 240,000 a year. So we almost got to that level, but that was a lot of units in the mix.
Yeah.
And that was the highest we ever got to. Normally, this year I think approvals are now running at 165,000, which is way below what we need to remove the shortfall we've already got, let alone the ongoing surge in impact of the ongoing surge in immigration levels.
Yeah. So I want to ask you about some what I call X factors in the international economy. Often there's something like COVID, like bird flu, like a GFC. Is there any kind of on the horizon, any kind of international or geopolitical shocks that you think could affect the Australian economy, and then secondly impact the property market in the coming couple of years?
Well, the biggest one would be some mishap in China, such that the Chinese property market collapses. Their property market is somewhat stressed. They had a model there which involved channeling excess savings from Chinese households into the property markets, and that led to a lot of developers putting up a lot of
Oh, Shane, you there? Uh-oh. Shane, I've lost you.
Still there, Rich?
Oh, sorry. Just say that again. It just cut out after the Chinese developers. Sorry, say it again.
Yeah. What happened? My phone rang. I don't
Oh,
know
did
how
it?
you
You
turn that off. But
maybe,
anyway,
maybe just put it on do
can you
not
edit
disturb.
this?
We'll edit this out. Yeah, we'll edit this out. Yeah.
Edit that bit.
Oh, that'll be at
Look,
47 minutes. Yep.
there's a few risk potential X factors globally. The bigger one would be if there's a collapse in the Chinese property market. It's been a source of strength in the Chinese economy for many years now as they recycle excess savings from the household sector into property construction. Looks like it's gone a bit too far, and that's causing problems for property developers. I think that's more a risk than likely to become a reality, though, because the Chinese authorities seem to be doing everything they can to prevent a big collapse in property developers, causing a wider ramification for the economy. But obviously, if it did occur, then that could bring down the Chinese economy, which could reduce demand for our key exports, which would then have an impact on our economy and hence the property market. So that's one to watch. Obviously, there's a lot of political events in the year ahead. I think something like 4 billion people worldwide out of 7 billion population face an election. So something like 2/3 of the world faces an election in the year ahead. Notable countries are India, I think US is a big one in there, South Africa, various other places. But anyway, obviously the US is one to watch with Donald Trump potentially making a rerun. But interestingly, I don't think that would necessarily cause a major problem for the US economy, at least not initially. Like, I'm not a great fan of Donald Trump. It does mean potential threats to democracy and US alliances. That's not great. But his policies are not necessarily negative for the US economy. So, it's a potential thing that could cause upset and concern, but I don't think it would necessarily cause a major problem for our economy.
Right.
The other big one is, some escalation of the war in Ukraine. That seems unlikely, or escalation of the war in the Middle East around Israel and Gaza to involve Iran. If that were the case, then Iran produces about 2% of world oil supply annually. I know there's bans on it, but it gets to other countries, and if those other countries can't get it, then it affects world oil prices. So far, the situation is contained to Israel and Hamas. Doesn't affect major oil producers, but if major oil producers like Iran get involved, then it could have wider ramifications. Yes. So that's obviously something to watch as well. Although I am conscious all the years watching these things. I know in the 70s, events in the Middle East had a big impact on oil prices, but one lesson from that is that you can often have blow-ups around Israel, and yet it doesn't have a lasting impact on the oil price. And so far, that's been the case, with the oil price actually, as we speak, lower than it was prior to Hamas's attacks on Israel.
Okay. And just domestically, just to finish off the domestic, are there any other kind of key sectors of the economy or business types that you think are going to be quite vulnerable going forward over the next 12 months?
Look, the main vulnerability is the consumer, and particularly retailing and discretionary spending. So that's probably the key vulnerability, and that's networking of the flow through of our economy. I think business investment holds up reasonably. It'll slow down, but it holds up reasonably well. Manufacturing seems to be doing okay in Australia. Obviously, lots of good and bad, and lots of good stories in that sector, but it's sort of doing okay. Services probably hold up a bit, although I think restaurants and cafes might suffer a little bit as consumer spending remains subdued.
Okay.
So there's no major area which is like a key risk.
And how do you think sort of the average household consumer and the home buyer maybe should sort of get ready to deal with the period of extended higher interest rates next year? Are there any particular ways you think they can prepare themselves better?
Well, the key thing to do was 2 years ago when we had those low fixed rates, locking at the low fixed rate, and
The horses bolted though on that one.
the horses bolted on that one, and then pay down your mortgage as quickly as you can in the process. So there's not really a lot Australians can do, but
Write it out.
Try as much as they can to keep up their payments. Just bear in mind that your banks don't want you to default any more than you want to default, because it causes major problems for them. Unless in the past, when banks call in loans, it just causes mayhem for them and can question their own banking business. So it's always best that if you're going through this period to make sure you call up the bank. You can extend your loan. You can perhaps switch to a interest-only period for a while. There's various things that can be done. Just make sure that if you do extend it or go to interest-only, that you once rates start coming down, you pull it back the other way.
Exactly.
Otherwise, you're paying your loan off for a lot longer.
Yeah.
But there are things that can be done, and I think one lesson from all of this, I think it might have been one of the well-known value investors said this, something to the effect that this too will pass. We're going through a period of high interest rates. There will come a time when rates start to come down again. And when you look at the cycle globally, it's interesting to note that there is talk now that US and Europe might start to cut rates earlier than expected. So
that's a positive sign for the domestically, isn't it?
It's a positive sign. It just sends a signal out that people, if you can hang on,
get through.
Even if you have to rely on the bank of mum and dad or whatever it is, sell one car or something.
Well, this is the point I often make to a lot of our investors out there, Shane, is that we get what I call the impatient investor, that it's all well and good when interest rates were 2% and you're getting a positive cash flow on a Sydney or Melbourne property, but suddenly when interest rates are at 6.5 and you're paying mortgage rates of 7 or whatever, and it's really hard to hang on, and you think, oh gosh, can I hang on for the end of the year? I always say to them, let's do the calculation over a 10-year period of what your capital growth is going to be. So if you are having to if it's going to cost you 20,000 or even 50,000 or whatever to hold that property, what's it going to deliver for you in 10 years' time? And it's really good for people to do those numbers rather than making a rash, impulsive decision to sell an asset because it's expensive to get into and out of the property market with stamp duty and other fees. So I'm always advising clients to just take a step back and have a think about your longer term implications of making those pretty quick decisions.
It's best to think for the long term.
And Shane,
getting in and out is disastrous.
Yeah, that's right. Yeah, a couple more questions before we finish up. Do you see that there's any opportunities for property investors while the times are a bit tougher and tighter in the year ahead?
Well, my view has always been that you try and buy property when interest rates are up, not when they're down. It's a bit like Warren Buffett's comment that you buy when there's fear. You get bullish when everyone's fearful.
Love it.
You get bearish, or you sell when everyone's optimistic. So it's the same here. If we do get a bit of a dip in some areas, in some cities, that will provide opportunities, as the dip into 2019 did, and the dip into the mini one into the pandemic did in 2020, and likewise the one we saw in 2022. These provide opportunities for far-sighted investors because as prices dip, value improves. And even though it may cost you a little bit when interest rates are still higher, the odds are those rates will come down. I think in my own experience getting into property, and I'm not a massive property investor or anything, the time I got in was always when interest rates are high and there's no other buyers around. It's a dead time in the market. Often winter's a good time, I find. Property's partially at auction, you show up. Everyone's scared off by the high interest rates.
Yeah, great.
You find yourself a bargain.
Tell us more about that. Did you get a good result in what you bought, and was it long ago?
Well, I think I did. As I say, I'm not a big property investor, and initial one was an investment. I was at Rentvest. That's how I got into the property market. I think it's become more of a trend now.
Yeah.
When I was younger, my girlfriend, now wife, we bought a property way beyond our means, but you can do that when we're living at home with our parents.
Yeah.
You can do that when that's the situation. You get the benefit of negative gearing. Interest rates were still high, so this was actually in the early 90s. So rates were 10% or something. I forget the precise number, but it seemed quite high at the time. They'd come down from those extremes in the late 80s, but and then it went up, and we were able to get the mortgage down, virtually pay the mortgage off really quickly because of the benefit of negative gearing, and then it went up, and then enabled us to then sell that and get into a bigger property, which again initially we rented out, and then ultimately moved into. But that second property was a real bargain. You won't come across anything like that in that sort of value at that point in time. But it was the middle of winter. Property had passed in at an auction. Interest rates had gone back up again. The seller, the vendor, was motivated because they had bridging finance. So the lesson from all of that for me is that if you sort of look around a little bit when times are tougher, it's a lot easier. It might feel like a bridge too far. You have to borrow more or borrow a lot, and you're paying a higher interest rate. But that's often when the bargains are found. And
exactly.
It sort of reminds me of just the importance of value, and the return you will get often reflects the price you pay. I mean, in general speaking, you can do pretty well out of Australian property, even if you pay top dollar over a long period of time, you'll get a return on it. But if you're strapped for cash a little bit and you want to get in, the best time is when the market's down, and that does enhance your return because you're coming off a much lower base.
That's you actually just talking about price and value, you remind me about that joke about economists, So the joke about economists is they know the price of everything and the value of nothing.
Jokes about economists.
Absolutely, you could always plenty of derogatory jokes, but we could always put ourselves down. But look, Shane, it's been wonderful to chat. One last question I have for you: is there any other investment advice or any other best tip you've ever received that you'd like to share with our audience?
Well, this is a funny one. Over the years, you pick up lots of things from people, but the one that always stuck out to me was when I was much younger, early in my career, we'd go to these presentations by this economist called Dr. Don Stammer, who was one of the first investment bank economists in Australia, associated with a stockbroker called Bain and Company, later merged with Deutsche Bank. But he would constantly say over and over and over, make the most of the magic of compound interest and don't get blown off by the cycle. And to me, that's critically important. Whether you're investing in shares or property or just investing generally, you've got to make the most of compound interest. So compound interest is the way returns compound on returns, particularly when you're reinvesting any income you get along the way. It does work like magic. That's how you get those lines which go up in an exponential fashion. If you look at the value of Australian property over the period since 1900, it's gone up in an exponential fashion. Curve sort of eventually starts going almost vertical, not quite, but almost vertical after long periods of time. My numbers, I got these numbers when I put together for my original university thesis, and I've kept updating them. But if you look at the period since 1926, for which I have data for shares and residential property, the average return from shares and property has been about 12% per annum. They're both about the same. Obviously, shares come with more volatility. Property is less liquid. There's an argument to have both in some ways. But the trick is not to get blown off at the wrong point, not to sell up. When we go into the GFC, the GFC was a fantastic buying opportunity in Australian property and Australian shares ultimately. And then you will make the most of compound interest. Whereas if you're going to sit on the sidelines and have your money sitting in bank deposits, you're never going to do that well. If you look at the returns you got from bank deposits from about 1926, probably around 4.5%. But just compound those different rates of return, you'll end up with a far smaller value from your original investment than if you put it into a growth asset like shares or property. But allied to all of that, of course, to make the most of compound interest, you've got to make sure you don't get blown off the cycle. Don't become impatient, as you referred to earlier. Focus on the long term. Yes, you're going to have rough times. If you're not prepared for rough times, then perhaps you shouldn't be there. But those who make money out of investing in property can sail or go through those rough times. It's unpleasant and horrible, but you've got to hang in there.
Fantastic advice, Shane. That's just brilliant. Really appreciate you sharing your wisdom, your knowledge. I've got to say the magic of compound interest is just, it is I think Einstein said it's the seventh wonder of the world. And I've even looked at my own portfolio and done exactly that. I remember during the GFC, I bought 3 properties that year, and just recently I bought when the market was a bit down, I bought another 3. So it's just when you can have those opportunities to see there's a gap in the market, it does really pay dividends to take advice. But Shane, thank you so much for all of your time today. Your great advice, really appreciate it, and really appreciate you being on the show.
My pleasure, Rich, and thanks for having me. It's been great chatting to you.
Fantastic.
And all the best to everybody listening.
Thank you so much. And look, if you'd like any more information about buying property, please visit my website, propertybuyer.com.au, and we will be sharing this online. So really appreciate you sharing. If you found this information useful, do share it with your friends, family, or colleagues, and it's the only way that we can grow our podcast. But Shane, thanks again, and we look forward to seeing you again on the Property Buyer podcast. Bye for now.
Sounds good, Rich. Thank you.
Thanks for being with us on another Property Buyer podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry, and we'd be delighted to help. Please visit our website at propertybuyer.com.au, where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer podcast.